Hi, this is Dee, speaking to you from thegreshka.com. Today we discuss trade number 47, a call credit spread we made on PRGS in anticipation of the March 29 earnings after the closing bell. So this is, again, an earnings play, and the announcement of PRGS earnings is after market close. So what we did here was we sold a 30 strike, one contract of a 30 strike call option expiring on April 21. That's 23 days apart from the March 29, and bought the 35 strike call option as a hedge, expiring also at the same day on April 21. So what does this transaction give us? This gives us a risk generally of 500 minus the credit that we received. The net credit that we received for this transaction is 49 minus 59 cents. So the net credit is, the max risk is, 500, which is the difference of the strikes, 35 minus 30, times the multiplier for the standard equity options of the AMIs, of the American options. That gives us 500 minus this net credit of 48.41. So again, max risk will be 451.59. This just means if the trade goes totally out of control, you didn't do anything, it went through both strikes and didn't come back, and it expired very, very much in the money, you would lose at a max $451. But this is not our aim. Anyway, this is what happened with the trade. So March 30 came, and on the next day, PRGS, let's take a look at the chart. PRGS, so this was March 29, and we decided to put or sell a call option with a 30 strike here, and your hedge is somewhere above here, 35. Come earnings day, earnings was, I think, better than expected. Yeah, better than expected, but well, this was normal, I guess, for PRGS, but in any case, the stock went up, crashed, and what we did here was I think when March 30 markets open, on March 30 market open, we decided to take out the trade at 49 and paid transaction fees of $1.09. Oh, one moment. Yeah, here we go. So we decided to close out the trade and buy back the combo that we sold for 49 and pay transaction costs of $1.09. So our total loss here is the sold combo, the net credit from the sold combo minus the buyback price plus this commission. It's a total of $1.68 loss. but it's better than a bigger loss, I think, because in earnings trades, you just want to get quickly in and out of the trade and avoid getting stuck with a big loss, as it can whip against you. So again, we get into the trade and get, as soon as the market opens, as soon as the earnings comes out, you would want to generally close within the couple of hours that you have, or what goes wrong against you might just really hit you harder than just a cheap price of $1.68. So year to date, so actual loss is like 1.68 US dollars, and you didn't have any of the profits, but you had an actual loss of 0.37% negative of the max risk that you put on the table, the 451, and compounded on a yearly basis, or annualized on the yearly. This gives you, well, a total of 135.41, which means theoretically wiping out your account. But as you can see, we have other trades. Yeah, we have other trades that make us money. So yeah, we're pretty comfortable that this will generate in total on a portfolio basis, not this figure of 135.41 negative, but this will just diminish our ROI on our other juicier trades. So this is Dee. That's all for now. Wishing you success in trading, and keep in touch.